There is a single question that separates the amateur investor from the professional, the fleeting speculator from the generational wealth builder. It is a question that Warren Buffett has spent more than 70 years asking, a question that cuts through the noise of quarterly earnings reports, market sentiment, and flashy growth narratives. It is the ultimate litmus test for a truly great business, the one quality he is always willing to pay for, the one superpower that underpins the entire Berkshire Hathaway empire. The question is this: can this business, without losing a meaningful number of its customers, raise its prices by 10% tomorrow morning, and next year, and the year after that? If the answer is yes, you are not looking at a mere company, you are looking at an economic fortress, a private toll bridge on a busy highway of commerce. A business that possesses the single most valuable, most durable, and most misunderstood competitive advantage in the world of finance: pricing power. This is not about growth. It is about something far more potent. It is about sovereignty. The ability to dictate terms, not just accept them. The power to be immune to the brutal gravity of inflation, to be the master of its own financial destiny. For decades, the average investor has been conditioned to chase meteors. We are told to look for explosive revenue growth, disruptive technology, charismatic founders. We are drawn to the stories of companies that are conquering new markets at a breakneck pace. But Buffett learned a different lesson, a harder lesson, etched in the failures of the businesses he saw wither and die. He learned that growth without profitability is a vanity, and profitability without pricing power is a trap. It is a temporary state of affairs, always vulnerable to the next competitor who is willing to do it cheaper, to the next economic downturn that squeezes margins to dust, to the next wave of inflation that devours profits from the inside out. What we are about to embark on is a journey into the mind of the world's greatest investor, to dissect this one principle, this North Star of his entire philosophy. We will deconstruct it into its fundamental pillars, understanding not just what it is, but where it comes from, how to identify it, and how to harness its incredible force for your own portfolio growth. This is not another list of stock tips. This is the transfer of a mental model, a new lens through which you will see the entire business world. By the end of our time together, you will no longer look at a brand like Apple or Coca-Cola and see just a product. You will see an invisible, unbreachable moat. You will learn to distinguish the ephemeral success of a price taker from the enduring dynasty of a price maker. This is the hunt for economic royalty, and it begins with understanding the simple, devastating power of a 10% price hike. This is the core of Warren Buffett's strategy for beating the market, and it is the closest thing to a guarantee of long-term wealth management that exists. Our first step on this path is to understand pricing power not as an abstract economic theory, but as a tangible living force. We must see it in action, in a real-world decision that laid the groundwork for decades of incredible returns. To do that, we have to travel back to 1972. The world was a different place. Richard Nixon was in the White House, the Dow Jones Industrial Average was flirting with the 1,000-point mark for the first time, and two investors from Omaha, Nebraska, Warren Buffett and his partner Charlie Munger, were about to make a purchase that seemed on the surface utterly unremarkable. They bought a candy company, not a high-flying tech startup, not a global conglomerate, but a boxed chocolate business based in California called See's Candies. They paid $25 million for it. At the time, See's was generating about $4 million a year in pre-tax earnings. For Buffett, who had built his reputation as a cigar-butt investor finding mediocre businesses at dirt-cheap prices, this was a major departure. See's wasn't dirt cheap. It was a good business, but it wasn't a statistical bargain. It was, in their minds, a mature company, a pleasant, profitable, but ultimately stagnant little enterprise. They believed its growth prospects were limited. California was its home, and they didn't see a clear path to massive national expansion. Their plan was simple: buy this reliable cash cow, take its predictable profits, and use that money to invest in other, more exciting opportunities. They had no idea they had just purchased one of the most powerful educational tools of their entire careers. Shortly after the acquisition, a man named Chuck Huggins, the longtime manager of See's, came to Buffett and Munger with a proposal. He wanted to raise the price of the chocolates. Now, to the Buffett of 1972, this was a nerve-wracking idea. He was still steeped in the logic of commodity businesses. He came from the world of textile mills and department stores, where raising your price by a few cents could send your customers fleeing across the street to a competitor. His instinct was to hold the line, to compete on value, to not risk alienating the loyal customer base. He and Munger were genuinely worried. Would people really pay more for a box of chocolates? Was the brand strong enough? Or would a price hike be the first step in a long, slow decline? Chuck Huggins, who understood the soul of the business far better than its new owners, was adamant. He explained that See's Candies wasn't just selling cocoa, sugar, and nuts. It was selling nostalgia. It was selling a guaranteed positive experience. When a man bought a box of See's for his sweetheart on Valentine's Day, he wasn't just buying candy. He was buying the certainty that she would be happy. He was avoiding the risk of buying a cheaper, unknown brand that might taste waxy or stale. The price was a secondary consideration to the emotional payoff. The customer was not just a consumer, they were a devotee. Reluctantly, Buffett and Munger agreed. They sanctioned the price increase. And they held their breath. The result was a revelation that would fundamentally alter their investment philosophy forever. Sales did not drop. The customers did not leave. They grumbled a little, perhaps, but they paid the higher price. And then they did it again the next year. And the year after that. The profits, which Buffett and Munger had initially pegged at a stable $4 million a year, began to surge. That small, stagnant, $25 million investment has, to date, generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all of which was sent back to Omaha to be redeployed into other investments. It required almost no additional capital. It was a gusher of cash, fueled by one simple mechanism: the ability to consistently raise prices. See's Candies became Buffett's prototype, his laboratory for understanding the profound difference between a commodity business and a consumer franchise. He saw firsthand that the most valuable asset See's owned wasn't its factories or its recipes. It was a tiny sliver of real estate in the customer's mind. A piece of mental territory that equated See's with quality, happiness, and no-risk gift. This mental real estate was a toll bridge. Every year, they could raise the toll just a little bit, and the traffic would keep flowing, because the alternative routes were too fraught with peril and disappointment. This one experience, born from a $25 million bet on a California chocolate maker, was the foundational anecdote. It taught Buffett that the ultimate economic moat wasn't built of factories or patents, but of psychology. The magic of See's Candies, the reason Warren Buffett could raise prices year after year without catastrophic consequences, is not rooted in economics textbooks. It's rooted in the predictable and often irrational wiring of the human brain. To truly grasp pricing power, we must become students of behavioral science. The underlying psychological principle at play is a powerful combination of two cognitive biases: anchoring and adjustment, and the status quo bias. First, let's look at anchoring and adjustment. This bias describes our tendency to rely heavily on the first piece of information offered, the anchor, when making decisions. For See's customers, the anchor isn't the price. The anchor is the experience. It's the memory of the taste, the smell of the shop, the feeling of giving a gift that is always appreciated. Decades of consistent quality created a powerful anchor of premium experience in the customer's mind. When the price is presented, the customer doesn't compare it to the price of a generic Hershey bar in a vacuum. Instead, they adjust from their anchor of a guaranteed positive emotional outcome. The brain performs a subconscious calculation. This experience is a 10 out of 10 for me. The price went up from an 8 to an 8.5. The adjustment is small relative to the anchor's strength. Because the anchor of quality is so powerful, and so deeply embedded, a minor adjustment in price feels insignificant. The value proposition remains overwhelmingly positive. The purchase decision is already 90% made before the customer even looks at the price tag. Compounding this is the second principle, the status quo bias. Humans are creatures of habit. We have a strong preference for keeping things the way they are. Change is perceived as risky and effortful. Switching from See's Candies to a competitor, brand X chocolates, isn't a simple transaction. It's a cognitive leap. It introduces uncertainty. Will brand X be as good? Will my wife like it as much? What if it's a disappointment and I've wasted my money and ruined the gesture? The brain, seeking to conserve energy and avoid risk, defaults to the familiar, trusted option. The slight pain of paying a few dollars more for C's is far less than the potential pain and regret of a bad experience with an unknown alternative. Buffett isn't just selling chocolate, he is selling the avoidance of regret. This is an incredibly powerful product. People will pay a significant premium to not have to worry. This is the psychological moat. It's an energy barrier that competitors have to overcome. A small price difference is not enough to push the customer over that barrier. The competitor would have to offer a product that is not just cheaper but perceived as equally reliable and risk-free, a task that takes decades of flawless execution and billions in marketing to achieve. This is why pricing power is so rare and so durable. It's not built overnight. It's conditioned into the customer base over years, through thousands of positive interactions, until the brand becomes a mental shortcut for quality. It bypasses the rational, price-sensitive part of the brain and appeals directly to the emotional, risk-averse core. When a business achieves this, it has effectively rewired its customers' decision-making process to its own advantage. It has moved the conversation from what is the cheapest option to what is the safest, most reliable option. In that shift, a world of profitability is unlocked. Buffett's genius was in recognizing that what Chuck Huggins was describing was not a sales tactic, but a deep psychological phenomenon that could be identified, valued, and acquired. So how do we, as investors or entrepreneurs, take this powerful theory and forge it into a practical tool? How do we translate the story of See's Candies into a blueprint for our own executive decision-making and stock analysis? We need an applied mental model. Let's call it the See's Candies test, a simple but profoundly effective process you can use to evaluate any business, including your own. Step 1. Identify a product or service. This can be a company you are considering investing in, a competitor, or even the business you currently run. For the sake of this exercise, let's pick two examples: a high-end coffee shop like Starbucks and your local, independent cable company. Step 2. The hypothetical price shock. Imagine that the CEO of this company sends out a press release tonight. Effective tomorrow morning, the price of their core product or service is increasing by a clean 10%. A grande latte at Starbucks that was $5 is now $5.50. Your monthly cable bill that was $100 is now $110. It's a noticeable, unambiguous increase. Step 3. The annoyance gauge. Now run an honest self-assessment of your immediate emotional reaction as a customer. Would you be annoyed? For both Starbucks and the cable company, the answer is almost certainly yes. Nobody likes paying more for the same thing. A sense of irritation is the natural first response. This step is designed to clear the deck of the initial, universal negative feeling. The real test is what comes next. Step 4. The behavioral switch point. This is the heart of the mental model. After the initial annoyance fades, what do? Let's analyze Starbucks first. You're standing outside, looking at the new menu. You're annoyed about the extra 50 cents. But then you think about the alternatives. You could go to the 7-Eleven down the street for a cheaper coffee, but it's not the same experience. You could try the local artisanal cafe, but it's a 10-minute walk out of your way, and the line might be long. Your morning routine is built around this specific Starbucks. The barista knows your order. The Wi-Fi is reliable. You are habituated. The pain of switching is high. It involves changing your routine, accepting a lower quality product, or risking an unknown experience. So what do? Overwhelmingly, the data shows you will grumble, pay the $5.50, and walk inside. Starbucks passes the test. It has pricing power. Now, let's analyze the cable company. Your bill goes up by $10. You're annoyed. What do? You immediately think, what are my other options? You check to see if that new fiber optic service is available on your street. You look up the pricing for satellite TV. You investigate streaming services and wonder if you can cut the cord entirely. The pain of switching might be moderately high. It's a hassle to schedule an installation, but your loyalty to the brand is likely zero. You are a captive customer, not a happy one. If a viable competitor offered the same channels for $105, you would switch in a heartbeat. The cable company does not have true pricing power. It has a temporary, fragile monopoly that is constantly under threat. It fails the test. This simple four-step mental model is a powerful tool for fundamental analysis. You can apply it to any company in any industry. Can Apple raise the price of the next iPhone by $100? Yes. Their customers are locked into the ecosystem and identify with the brand. Can Delta Airlines raise all its fares by 10%? Not without losing significant business to American and United, who would gleefully hold their prices steady to capture market share. This blueprint trains your mind to look past the revenue figures and PE ratios and focus on the strength of the relationship between the business and its customer. It forces you to identify the presence or absence of a true, durable competitive advantage. This is the kind of analysis that leads to identifying high-quality stocks capable of long-term portfolio growth, not just short-term gains. To fully appreciate the brilliance of a principle, we must intimately understand its opposite. To grasp the heaven of pricing power, we must descend into the hell of its absence. This is the path of the 99%, the world inhabited by the vast majority of businesses that are caught in a brutal, soul-crushing race to the bottom. This is the world of the price taker. The antithesis of See's Candies is not another, less successful candy company. It's a business in a completely different domain, a domain Warren Buffett knew all too well from the early, painful part of his career, a textile mill. Imagine a factory in North Carolina in the 1970s that produces simple, undifferentiated cotton fabric. Let's call it Standard Textiles. The life of its manager is a daily nightmare. His product is a commodity. There is absolutely nothing that separates his yard of cotton from the yard of cotton produced by his competitor down the road, or his competitor in South Korea, or his competitor in India. His customers, clothing manufacturers, make their purchasing decisions based on one factor and one factor alone: price. The dumbest, most desperate, most irrational competitor in the global market gets to set the price for everyone. If someone is willing to sell cotton for 52 cents a yard, then 52 cents a yard is the price. Standard Textiles has zero pricing power. It has negative pricing power. It is a price taker. Let's apply our See's Candies test here. What happens if the manager of Standard Textiles decides to raise his price by 10% from 52 cents to 57 cents a yard? His phone would stop ringing. His order book would evaporate overnight. His customers wouldn't even be annoyed. They would simply call the next supplier on their list and place their order without a second thought. There is no brand loyalty. There is no emotional connection. There is no pain of switching. The decision is pure, cold, rational economics. The consequences of this reality are devastating. First, margins are perpetually razor-thin. The business is in a constant state of near death, earning just enough to cover its costs of capital. There is no surplus, no fat, no room for error. A small rise in the cost of raw cotton or energy can instantly plunge the company into losses. Second, it is a capital-intensive nightmare. To remain competitive, Standard Textiles must constantly invest in the latest, most efficient looms and machinery. But this new equipment doesn't allow them to raise prices. It merely allows them to stay in the game, to produce the cotton at the prevailing market price, and hopefully eke out a microscopic profit. It's a hamster wheel of reinvestment for zero gain and competitive position. Buffett famously described this as a business that requires you to keep putting more and more money in, just to get the same miserable returns out. This is the path of the 99% of businesses and, sadly, the 99% of investors who don't understand this distinction. They see a company in a huge industry, like airlines, steel manufacturing, or memory chip production, and they mistake revenue for success. They see a company growing its sales, but they fail to see that it's doing so with zero margin and no durable advantage. They buy the stock because it looks cheap on a price-to-earnings basis, not realizing that those earnings are fragile and illusory. The moment a competitor adds capacity or a recession hits, a price war erupts, and those paper-thin profits vanish, taking the stock price down with them. Investing in commodity-type businesses is the most common and costly market mistake. It's an active decision to enter a game where the rules are set by your least rational opponent. It is the exact opposite of the value investing philosophy that seeks to own a piece of a business with a unique and defensible position. Escaping this trap is the first and most critical step toward achieving true financial freedom. The ultimate purpose of any investment principle is to generate tangible financial results. The concept of pricing power is not just an elegant theory. It is a machine for creating cash. Its impact can be seen and measured directly on a company's financial statements, and understanding this connection is what separates wishful thinking from rigorous stock analysis. The direct financial connection between pricing power and wealth creation is most clearly expressed in two key areas: gross profit margins and return on tangible capital. Let's start with the gross profit margin. This is a simple calculation: revenue minus cost of goods sold divided by revenue. It tells you how much profit a company makes from each dollar of sales before accounting for overhead, marketing, and other operating expenses. A company with pricing power, like our See's Candies example, exhibits a beautiful and rare phenomenon: expanding gross margins over time. Let's put some numbers to it. In year one, let's say See's sells a box of candy for $20. The ingredients, labor, and packaging, the cost of goods sold, amount to $8. The gross profit is $12, for a gross margin of 60%, a very healthy number. Now, in year two, inflation causes the cost of sugar and chocolate to rise by 5%. The cost of goods sold for that same box of candy is now $8.40. A commodity business would be in trouble. It would have to absorb that cost increase, and its gross margin would shrink. But See's has pricing power. It raises the retail price not by 5%, but by 10% to $22. Its new gross profit per box is now $13.60, and its new gross margin is 61.8%. This is financial magic. The company didn't just pass on inflation. It used the cover of inflation to increase its own real profitability. This is the financial manifestation of the toll bridge. The cost of maintaining the bridge, the cost of goods sold, went up a little, but the owner was able to increase the toll by a lot more, widening the river of cash that flows to the bottom line. When you are conducting your fundamental analysis of a company, look at the 10-year history of its gross margins. Are they high? Above 40% is a good starting point. And more importantly, are they stable, or, even better, trending upward? This is the clearest quantitative evidence of a durable competitive advantage. The second, and perhaps more powerful financial connection, is to return on tangible capital employed. This sounds complicated, but the concept is simple. It asks, for every dollar the company invests in real physical assets like factories and equipment, how many dollars of profit does it generate each year? Commodity businesses, like our textile mill, have atrocious returns on tangible capital. They have to spend hundreds of millions on new looms just to eke out a few million in profit. The return is tiny. A business with pricing power is the polar opposite. See's Candies, after the initial $25 million purchase, required very little additional capital investment. They had their kitchens and their stores. The main asset generating the profit was the brand, which is an intangible asset that doesn't appear on the balance sheet at its true value. The business could grow its profits year after year simply by raising prices, without having to build dozens of new factories. This results in an astronomical return on the tangible capital actually used in the business. Buffett has stated that See's generates these incredible profits with almost no new capital required. This is the holy grail of business. It is a company that funds its own growth and then produces a surplus of cash on top of that. Cash that can be returned to shareholders through dividends and buybacks, or, in the case of Berkshire Hathaway, be reinvested into other wonderful businesses. This is the engine of long-term portfolio growth. Finding a business that combines high and expanding gross margins with a sky-high return on tangible capital is the ultimate goal of the value investing process. It is the direct financial fruit of the superpower known as pricing power. Now that we have established the definition of pricing power, we must explore its most potent source. Pricing power does not materialize out of thin air. It is not granted by a government or protected by a single patent. The most durable and formidable type of pricing power is manufactured. It is the result of a long, expensive, and deliberate process of building an intangible asset of immense value, a dominant brand. To understand this, we must turn to perhaps the most famous investment of Warren Buffett's career, an investment that perfectly illustrates how a brand can become an unbreachable economic moat. We must talk about the Coca-Cola Company. The story begins in 1988. The stock market was still reeling from the Black Monday crash of October 1987. Fear was rampant. Investors were selling indiscriminately, convinced that the good times were over. Amidst this panic, Warren Buffett was quietly, methodically, and aggressively buying. He wasn't buying beaten-down industrial stocks or obscure cigar butts. He was directing Berkshire Hathaway's capital into one of the most well-known companies on earth. Over a period of several months, he invested over $1 billion to acquire a roughly 7% stake in Coca-Cola. To the outside world, this seemed perplexing. Coke was already a massive, mature company. Where was the growth going to come from? Wasn't it already everywhere? Many Wall Street analysts saw it as a safe, boring, but ultimately uninspired choice. They were missing the point entirely. Buffett wasn't buying the company's bottling plants, its fleet of trucks, or its secret formula. He was buying the brand. He had been a consumer and admirer of the company for over 50 years. He'd seen its product in every corner of the world he had ever visited. He understood that Coca-Cola had achieved something that very few businesses ever do. It had staked a claim to a piece of the human mind, globally. He famously talked about share of mind. If you asked 1 billion people around the world to name a brown, carbonated soft drink, the word Coke would leap to their lips. This mental dominance was a far more valuable asset than any factory. Buffett performed a thought experiment. He imagined trying to create a new cola brand to compete with Coca-Cola. How much would it cost? You could perfect a formula, build state-of-the-art bottling plants, and design a brilliant logistics network. But then came the impossible part, erasing the century of memories, associations, and habits that people had with Coke. The memories of drinking it at a baseball game as a kid. The association with Christmas, thanks to decades of Santa Claus ads. The simple, unthinking habit of ordering a Coke with a meal. To displace that would require not billions, but hundreds of billions of dollars. And even then, success would be far from guaranteed. He concluded that the brand itself constituted one-of-a-kind economic moat, an advantage that was virtually unassailable. He saw that this share of mind gave Coca-Cola extraordinary pricing power. The cost of the syrup in a can of Coke is pennies. The rest of the price the consumer pays is for the brand promise, the distribution, and the consistent experience. This allowed the company to slowly, almost imperceptibly, raise its prices year after year, all over the world, outpacing inflation and generating a torrent of cash flow. The company wasn't selling a beverage, it was selling an idea, a feeling, a moment of happiness for a very low absolute price. The customer wasn't making a complex financial calculation. They were satisfying a small, immediate craving with a product they trusted implicitly. It was the Seize Candies principle on a global, multi-billion-dollar scale. The $1 billion investment that seemed so staid and boring in 1988 has since paid Berkshire Hathaway billions upon billions in dividends and is now worth well over $25 billion. It is a testament to the alchemy of brand loyalty, the process by which a simple product is transformed into an engine of generational wealth. The seemingly magical ability of a brand like Coca-Cola to command loyalty and pricing power is, once again, not magic. It is a direct result of exploiting deep-seated psychological triggers. The two most powerful principles at play in the creation of a dominant brand are social proof and habit formation. Understanding these is crucial for any investor or business leader aiming for long-term success. Social proof is the powerful human tendency to assume that the actions of others reflect the correct behavior in a given situation. When we are uncertain, we look to the crowd for cues. If everyone is doing it, it must be the right thing to do. Coca-Cola is perhaps the greatest masterpiece of social proof ever engineered. The company's marketing for over a century has been relentlessly focused on showing people, happy people, beautiful people, families, friends, all over the world, enjoying a Coke. The product is ubiquitous. It's in every vending machine, at every movie theater, on every restaurant menu. This creates a self-reinforcing loop. You see others drinking Coke, which makes you more likely to drink Coke, which in turn becomes a social signal for others. The brand isn't just a product. It is a piece of the social fabric. It is the default, the normal, the accepted choice. This overwhelming social proof creates a significant barrier to entry for any competitor. A new cola brand isn't just competing on taste or price, it's competing against the ingrained social norm. Choosing the new brand is a conscious act of deviation. Choosing Coke is an unconscious act of conformity. The brain, ever the conserver of energy, overwhelmingly prefers the latter. This is why celebrity endorsements are so effective. They are a supercharged form of social proof. If a globally admired athlete or movie star drinks this product, it signals to the masses that it is a desirable, high-status choice. This is not rational persuasion, it is a primal appeal to our instinct to follow the herd. The second pillar of the brand's psychological fortress is habit formation. A significant portion of human behavior is not driven by conscious decision-making, but by habit. Charles Duhigg, in his book The Power of Habit, describes a neurological loop at the core of every habit: a cue, a routine, and a reward. Coca-Cola has masterfully inserted itself into countless daily loops. The cue might be the mid-afternoon energy slump. The routine is to walk to the vending machine and buy a Coke. The reward is the triple hit of sugar, caffeine, and the satisfying fizz. This loop, repeated thousands of times, becomes automated. The person no longer thinks, "What should I do to feel more alert?" The thought process is short-circuited directly to, "I need a Coke." Once a habit is this deeply ingrained, price becomes a trivial factor. The user is on autopilot, seeking the neurological reward. A small price increase is not enough to break the habit loop. The effort required to consciously stop, evaluate alternatives, and choose a different routine is far greater than the minor financial pain of paying an extra quarter. Businesses that successfully weave their products into the daily habits of their customers, like Starbucks with the morning coffee routine or Apple with its seamless ecosystem of devices, build a moat that is incredibly difficult for competitors to assail. They are no longer competing for a customer's dollar. They are competing for a permanent slot in their daily routine, a battle that is fought on the terrain of neuroscience, not just economics. This is a core component of building brand value and achieving the financial freedom that comes with it. How can we, as aspiring investors and strategists, move from admiring brands like Coca-Cola to systematically identifying the next generation of them? We need an applied mental model, a practical blueprint for auditing the strength of a company's brand and its resulting pricing power. Let's call it the Brand Intangible Asset Audit. This is a qualitative checklist designed to go beyond the numbers and assess the share of mind a company truly owns. Step 1. The verb test. This is the simplest and most powerful indicator of ultimate brand dominance. Has the brand name become a verb in common language? We don't search for something online, we Google it. We don't have a video conference, we Zoom. We don't ask for a facial tissue, we ask for a Kleenex. When a brand achieves this status, it has transcended mere product identity. It has become the default term for the entire category. This is the highest level of mental real estate ownership, and it grants extraordinary pricing power. A company that passes the verb test is almost always a high-quality stock with a deep economic moat. Step 2. The no-logo test. Imagine the company's core product without its logo or brand name. Could you still immediately identify it? Think of the iconic curved shape of a Coca-Cola bottle, the distinct design of a Porsche 911, or the user interface of an iPhone. If the product's design language itself is a powerful brand identifier, it shows a level of integration and distinctiveness that is hard to copy. Now ask the more difficult question. If you stripped the logo off the product and a competitor's product, would the customer still pay a premium for the original? For an iPhone, the answer is yes, because the premium is for the software ecosystem, the user experience, and the status, not just the Apple logo on the back. For a generic polo shirt, if you remove the alligator or polo pony logo, the willingness to pay a premium evaporates. This test separates true brand value from mere logo slapping. Step 3. The story and emotion audit. What is the first feeling or story that comes to mind when you hear the brand's name? For Nike, it's inspiration, athletic achievement, just do it. For Disney, it's magic, childhood, family. For Harley-Davidson, it's freedom, rebellion, the open road. Great brands don't sell products, they sell emotions and identity. A company whose brand evokes a strong, specific, and positive emotion has a direct line to the customer's decision-making center, bypassing the rational, price-sensitive brain. If a brand evokes no emotion, or, worse, negative emotions like frustration or annoyance, think of our cable company example, it has no brand equity and therefore no pricing power. Step 4. The price premium gauge. This is a research-oriented step. Go online and compare the price of the company's product to its nearest competitors. Is there a consistent and significant price premium? Apple iPhones consistently sell for a higher average price than Android phones. A Rolex watch costs multiples of other high-quality Swiss watches. This isn't just about being more expensive. It's about successfully commanding that higher price over many years across a full product line. A persistent price premium is the most direct, quantifiable evidence of brand-driven pricing power in the market. This step in your stock analysis provides the hard data to back up the qualitative assessments from the first 3 steps. By systematically applying this 4-step audit, you can develop a much more sophisticated understanding of a company's competitive advantage and its potential for long-term portfolio growth. To truly internalize the immense value of a brand-driven moat, we must examine the bleak landscape of its antithesis. The path of the 99% is littered with companies that sell products, not brands. They are the polar opposite of Coca-Cola. They are the producers of store brand cola. Let's imagine a company called Value Soda Inc. Their entire business model is built on being the cheaper alternative. They create a cola that, in a blind taste test, is 95% indistinguishable from Coca-Cola. They package it in a red and white can. They place it on the grocery store shelf right next to the real thing, for 30% less. From a purely rational perspective, Value Soda should be a huge success. The product is nearly identical, and the price is significantly lower. Yet, these types of businesses almost never achieve significant, lasting profitability or scale. Why? Because they are trapped in a world without a psychological anchor. They are attempting to compete on the battlefield of logic and price, a battlefield where no one ever truly wins. The first fatal flaw of value soda is the complete lack of social proof. No one has ever felt a sense of pride or social status by showing up to a party with a case of store-brand cola. It is a brand that signals, "I am making a budget-conscious choice," which is often perceived as a lower status signal. It will never be featured in movies. It will never sponsor the Olympics. It has no cultural currency. It exists only as a point of comparison to the real thing, forever in its shadow. It lacks any aspirational quality, and therefore, it can never command a premium. The second flaw is the inability to create a habit loop. While the product might be physically similar, it does not deliver the same neurological reward. The reward of drinking a Coke is not just the taste, it's the feeling of drinking a real Coke, the reinforcement of a lifelong habit and a global social ritual. The experience of drinking value soda is hollow by comparison. It is a purely functional act of quenching thirst, devoid of the deeper psychological payoff. Therefore, it never becomes an automated, unconscious habit. It remains a conscious, deliberate choice to save money, a choice that has to be reevaluated every single time. The disastrous consequence of this model is a permanent state of price slavery. Value soda's only reason for existence is its price gap with Coca-Cola. If Coke costs $2 and value soda costs $1.40, it might capture some price-sensitive customers. But what happens when another company, Super Value Soda, enters the market at $1.30? Value soda has no other weapon. It cannot appeal to loyalty, nostalgia, or quality perception. It must lower its price to $1.29, or it will perish. It is locked in a perpetual price war, where margins are always trending toward zero. The company can generate billions in revenue, but it will never build lasting wealth because it has no power, no sovereignty, and no moat. This is the fate of the 99%, a constant, exhausting struggle for survival in a market that views their product as a fungible commodity. It is a path that smart investors following the Warren Buffett strategy learn to avoid at all costs. The immense, almost magical power of a brand has a direct and quantifiable home on a company's financial statements. For those skilled in fundamental analysis, the economic value of an asset like the Coca-Cola brand is not just a marketing concept, it is a tangible generator of financial performance. The primary way this manifests is through the concepts of goodwill and intangible assets on the balance sheet, and more importantly, in the superior return on capital that these assets generate. When one company acquires another for more than the fair market value of its physical assets, like factories, inventory, and cash, the excess amount is recorded on the acquirer's balance sheet as an asset called goodwill. This is, in essence, the accounting world's attempt to put a number on the value of the acquired company's brand, customer relationships, and other intangible strengths. When Kraft Foods bought Cadbury, a huge portion of the purchase price became goodwill, representing the value of the Cadbury brand name and its loyal customer base. For an investor, a balance sheet with a large amount of goodwill from smart acquisitions can be a sign that the company is a collection of powerful brands. However, the true financial connection is not the accounting entry itself, but what that underlying intangible asset produces. A powerful brand is an economic asset that allows a company to generate vastly higher profits, with far less physical capital than a generic competitor. Let's return to our Coca-Cola versus value soda example. To generate, say, $100 million in annual profit, value soda would need to invest heavily in the most efficient, large-scale, low-cost factories imaginable. Their business is a game of pennies, so they need immense volume and ruthless efficiency. Their return on tangible assets would be low. They might need $500 million in physical plant and equipment to generate that $100 million in profit, a 20% return. Coca-Cola, on the other hand, can generate that same $100 million in profit from a much smaller physical asset base. Why? Because a significant portion of their profit comes directly from the brand premium. They can charge more per can, leading to higher gross margins. The brand does the heavy lifting, not the factory. They might only need $250 million in physical assets to generate the same $100 million in profit, a 40% return. Their return on invested capital, ROIC, is double that of the generic competitor. This superior return is the direct cash flow consequence of the brand's power. It is the brand working as an invisible factory, producing high-margin profits with no need for new bricks and mortar. This is the secret to the compounding machine that is a collection of high-quality brands. They are capital-light and cash-heavy. They produce floods of free cash flow, the cash left over after all expenses and investments are paid, which can then be used to pay dividends, buy back stock, or acquire other companies with strong brands, repeating the virtuous cycle. When you analyze a business, don't just look at the earnings. Look at how much capital was required to produce those earnings. A business that can grow its earnings consistently, without having to proportionally grow its asset base, is the holy grail of long-term investing. It is the ultimate financial manifestation of a brand's power to command both the minds and the wallets of its customers, a cornerstone of any serious wealth management strategy. We've explored the power of a consumer franchise, the toll bridge built on psychology and brand. But to truly understand its importance, we must journey into its dark reflection, the commodity business. This is a world Warren Buffett knows intimately, not from a place of triumph, but from one of his biggest and most instructive failures. This is the story of his original sin, the business that gave Berkshire Hathaway its name and taught him the brutal lesson of the price-taker's prison. It was a textile mill in New Bedford, Massachusetts. In 1962, Buffett began buying shares of Berkshire Hathaway. On paper, it looked like a classic cigar butt investment. The stock was trading for less than the company's working capital per share. It seemed impossibly cheap. He saw a struggling but asset-rich business that he believed he could turn around. By 1965, he had taken control. And for the next 20 years he would fight a losing battle against the inexorable, brutal economics of the American textile industry. It was a war he could never win, and the experience seared the concept of the commodity trap into his soul. The business of Berkshire Hathaway was to produce textile linings for men's suits. It was a pure commodity. Their product was indistinguishable from the dozens of other mills in New England, and increasingly from the hundreds of mills in the American South and overseas. The customers, the suit manufacturers, had all the power. They would play one mill against another, negotiating relentlessly for a fraction of a cent per yard. Buffett later wrote one of the most famous lines in his annual letters, describing this period. "The dumbest sot in the textile business could set the price, and we all had to follow." He and his brilliant manager, Ken Chase, worked tirelessly. They improved efficiency. They bought the latest Swiss and German looms. They consolidated operations. They did everything right from a management perspective. And it didn't matter. Every dollar they saved through efficiency was immediately competed away in the form of lower prices. Every new loom they bought, which cost hundreds of thousands of dollars, didn't give them an advantage. It merely allowed them to stay in the game for another year. It was a capital-intensive treadmill to nowhere. He was pouring money into the business, but the competitive moat wasn't getting any wider. In fact, it was shrinking, as foreign competition with lower labor costs flooded the market. For 20 years, Buffett funneled the small, inconsistent profits from the textile mill into other, better businesses. He was using a dying enterprise as a financial vehicle to acquire wonderful companies like See's Candies and the Washington Post, but the mill itself was a constant drain on his capital and his psychic energy. Finally, in 1985, he faced the inevitable and closed the last of the textile operations. He had spent 2 decades trying to fix an unfixable business model. The lesson was profound and permanent. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The quality of the business, its intrinsic economics, is paramount. No amount of managerial genius can turn a commodity business into a great one. The experience with the Berkshire textile mill was the antithesis of the See's Candies story. See's was a capital-light gusher of cash. The mill was a capital-heavy sinkhole. This failure became the bedrock of his modern investment philosophy, a constant reminder to flee from the price-taker's prison and seek out the freedom of the economic fortress. Why do so many intelligent business leaders and investors, including a young Warren Buffett, fall into the commodity trap? The answer lies in a pair of powerful cognitive biases that distort our judgment and lead us down the path of value destruction: the sunk cost fallacy and herd behavior. The sunk cost fallacy is our tendency to continue with a venture or investment if we have already invested significant resources, money, time, or effort, even when it becomes clear that the venture is failing. The rational brain knows that past, unrecoverable costs are irrelevant to future decisions. But the emotional brain hates to admit defeat. It feels as though abandoning the project would mean wasting the initial investment. For 20 years, Buffett experienced this. He had invested his capital and his reputation in turning the textile mill around. Each new loom he purchased was another sunk cost, another psychological anchor making it harder to quit. He was trying to get his money back from a business that was structurally incapable of providing a good return. The emotional pain of admitting a multi-million-dollar, multi-decade mistake is immense. This fallacy keeps managers pouring good money after bad into failing divisions and investors holding on to losing stocks in commodity industries, hoping for a turnaround that the underlying economics will never permit. Compounding this is the powerful force of herd behavior. This is our innate instinct to follow the actions of a larger group. In the business world, if an entire industry is focused on cutting costs and competing on price, it feels safe and correct to do the same. When all the other textile mills were buying new, more efficient looms, it would have seemed like managerial malpractice for Buffett not to do so. The herd was stampeding in the direction of capital expenditure as the solution to poor profitability. To stand apart from the herd, to declare that the entire game is flawed and refuse to play, requires extraordinary intellectual independence and confidence. Investors exhibit the same behavior. When a sector like oil and gas or mining is in a cyclical upswing, money pours in. Everyone is talking about the rising price of the commodity. Analysts issue buy ratings. The media trumpets the boom. The fear of missing out becomes overwhelming. Investors pile in, not because they have analyzed the long-term competitive position of any single company, but because the herd is running in that direction. They forget that at the peak of the cycle, these companies are still price takers, utterly dependent on a global price they cannot control. When the cycle inevitably turns, the herd reverses, and the same investors are trampled in the stampede to get out. Escaping the gravitational pull of these two biases is a hallmark of superior executive decision-making and a prerequisite for beating the market over the long term. Buffett's eventual decision to close the mill was his final, painful graduation from the school of herd behavior and sunk costs. To avoid the fate of the Berkshire textile mill, we need a practical, applied mental model for identifying these dangerous investments before they enter our portfolio. Let's create the commodity litmus test, a simple checklist of questions to ask about any business to determine if it resides in the price taker's prison. Question 1. Is the purchasing decision made almost exclusively on price? This is the most important question. Put yourself in the shoes of the customer. When you are buying this product or service, what is your primary consideration? For gasoline, it's price. You will drive across the street to save 3 cents a gallon. For a gigabyte of data storage in the cloud, it's price. For basic steel beams, it's price. For most airline tickets, it's price. If the answer is an unequivocal yes, you are looking at a commodity or near-commodity business. There is no brand loyalty or switching cost to protect it. It has no moat. Question 2. Is the product fundamentally undifferentiated from its competitors? If you removed the labels, could you tell the difference between the product of Company A and Company B? Could you tell the difference between a grain of wheat from one farm and another? Or a memory chip from 2 different manufacturers? If the product is fungible, the business is destined to compete on price. Contrast this with an iPhone. It is radically differentiated from an Android phone through its operating system, its app store, and its industrial design. This differentiation is the source of its pricing power. A lack of differentiation is the source of a commodity business's weakness. Question 3. Does the industry suffer from chronic overcapacity? Commodity industries are notorious for their boom and bust cycles. When the price of the commodity is high, every company rushes to add new capacity. They build new factories, dig new mines, plant more acres. This inevitably leads to a glut. The market is flooded with supply, which causes the price to crash. The industry is then stuck with massive, expensive, and underutilized assets, leading to years of losses and bankruptcies. Look at the history of the airline industry, the steel industry, or the shipping industry. It is a story of chronic overcapacity and value destruction. A business that operates in such an environment is in a constant struggle for survival, not a steady march toward prosperity. Question 4. Is the business a high-cost producer? Within a commodity industry, the only temporary advantage a company can have is to be the lowest-cost producer. The company that can extract the oil or manufacture the steel for the lowest price can survive the downturns better than its rivals. When you are analyzing a company in a commodity-like field, it is absolutely essential to determine where it sits on the cost curve. If it is a high-cost producer, it is in a truly terrifying position. It will be the first to lose money when prices fall and the last to make money when they rise. It is the weakest animal in a very dangerous herd. By systematically asking these 4 questions, you can quickly diagnose the health of a business's competitive position. This litmus test serves as a powerful filter in your stock picking process, helping you to immediately discard the vast majority of businesses that fall into the price taker's prison, and allowing you to focus your time and capital on the rare gems that possess true, durable economic moats. This is a fundamental pillar of a sound, long-term investing strategy. The path of the 99%, the antithesis of the commodity litmus test, is to be seduced by the siren song of cyclicality. The average investor fails not because they are unintelligent, but because their timing is precisely catastrophically wrong. They fall in love with commodity businesses at the exact worst moment. Let's trace the arc of a typical, disastrous investment in a commodity stock, say a copper mining company we'll call Mountain Miners. The cycle begins in a recession. The price of copper is low. Mountain Miners is losing money, its stock is in the gutter, and no one is interested. Then, the global economy begins to recover. Construction picks up in China, electric vehicle manufacturing, which uses a lot of copper, accelerates. Demand for copper starts to outstrip supply. The price of copper begins to rise. This is when the trap is set. As the price of copper moves from $2 a pound to $3, Mountain Miners swings from a loss to a modest profit. Its stock price doubles from its lows, but it still looks cheap. Then, as the economic boom gathers steam, copper hits $4 a pound. Now Mountain Miners is making enormous profits. All of its costs are relatively fixed, so every incremental dollar in the copper price flows almost directly to the bottom line. The company's earnings explode. The media begins to run stories about the new paradigm for copper. Wall Street analysts, exhibiting classic herd behavior, upgrade the stock to a strong buy. This is the point of maximum danger, and it is precisely when the average investor gets interested. They see the headline earnings, they see the soaring stock price, and the fear of missing out becomes unbearable. They pile in, buying Mountain Miners stock at the peak of its earnings and the peak of its valuation. They are buying a fair company at best, at a wonderful price for the sellers. But they have forgotten the fundamental nature of the business. Mountain Miners is a price taker. It has no control over its destiny. And the high price of copper has already sown the seeds of its own destruction. All over the world, the high price has incentivized other companies to reopen old mines and invest billions in new ones. Supply begins to flood the market. At the same time, the economic boom starts to cool. Demand falters. Suddenly, there is a copper glut. The price collapses, from $4 back to $2. The earnings of mountain miners evaporate even faster than they appeared. The company swings back to massive losses. The stock price plummets by 80 or 90%. The average investor who bought at the top is wiped out. They either sell in a panic, locking in a devastating loss, or they hold on for years, a victim of the sunk cost fallacy, praying for another boom that may be a decade away. They failed to apply the commodity litmus test. They mistook a temporary, cyclical upswing for a permanent state of high profitability. They chased the story instead of analyzing the structure of the business. This is the path of the 99%, a path of guaranteed underperformance, and the antithesis of the patient, quality-focused value investing strategy that builds lasting wealth. The devastating financial impact of operating as a price taker is brutally exposed in a company's return on invested capital, or ROIC. This metric is the truest measure of a business's economic quality, and for commodity businesses, it tells a story of relentless value destruction. ROIC is calculated by taking a company's net operating profit after taxes and dividing it by its invested capital, which is typically the sum of its debt and equity. It answers the fundamental question, how good is the company at turning capital into profits? Let's go back to our textile mill. Suppose in a given year the mill had $100 million of invested capital tied up in its looms, buildings, and inventory. And let's say that in a good year it managed to generate $10 million in operating profit. Its ROIC would be 10%. This might seem acceptable, but it's dangerously close to the company's cost of capital, the interest it pays on its debt, and the return that equity investors expect. In a good year, it's barely creating any real economic value. Now consider a bad year, when a flood of cheap foreign imports causes prices to drop. The company's operating profit might fall to just $2 million. Now its ROIC is a miserable 2%. The company is actively destroying value. It has $100 million of capital tied up in the business, but it's generating a return far below what that capital could earn in a simple government bond. This is the financial reality of the price taker's prison. The returns are low in the good times and abysmal or negative in the bad times. The situation is made even worse by the relentless need for reinvestment. Let's say a new, more efficient loom costs $5 million. The company is forced to buy it just to keep up with competitors. But this $5 million investment doesn't allow the company to raise prices. It doesn't widen the moat. It only allows the company to continue earning its pathetic 2% return on a now larger capital base of $105 million. This is the hamster wheel Buffett described. The company is running faster and faster, spending more and more money just to stay in the same unprofitable place. Contrast this with a business that has pricing power, like a dominant software company. It might have the same $100 million of invested capital, but because of its brand and the high switching costs of its customers, it can generate $50 million in operating profit. Its ROIC is a phenomenal 50%. When it reinvests its profits in research and development, it creates even better products that further lock in its customers, allowing it to raise prices even more, leading to an even higher ROIC in the future. One business is in a virtuous cycle of value creation. The other is in a vicious cycle of value destruction. As an investor seeking financial freedom, your primary job is to distinguish between the two. A deep analysis of a company's historical ROIC is one of the most effective tools in your arsenal. A consistent history of high ROIC is the clearest financial signature of a deep economic moat and the pricing power that comes with it. One of the most profound benefits of owning a business with pricing power, a benefit that has become acutely relevant in our modern economy, is its unique ability to act as a powerful shield against the wealth-destroying effects of inflation. When the general level of prices in an economy is rising, most businesses suffer. Their costs for labor, raw materials, and energy go up, but they are unable to pass these costs on to their customers without losing business. Their profit margins get squeezed. For a business with a true economic moat, however, inflation is not a threat. It can be an opportunity. To understand this, we must go back to the 1970s, a decade of runaway inflation, and look at another of Buffett's masterstroke investments, the Washington Post. In 1973, Buffett began investing in the Washington Post Company. At the time, the company's stock was beaten down, trading at a fraction of what Buffett calculated its intrinsic value to be. Wall Street saw a newspaper, an old media company in a competitive industry. Buffett saw something very different. He saw an economic fortress with two powerful, interconnected moats. The Washington Post was the dominant newspaper in the nation's capital. It had what economists call a natural monopoly. If you were a senator, a lobbyist, or a government official, you had to read the Post. It was an essential part of your daily life. This gave it pricing power over its subscribers. It could raise its cover price every year, and the number of cancellations would be minimal. But the real pricing power came from its relationship with advertisers. If you were a department store, a car dealership, or a real estate agent in the Washington, D.C. area, and you wanted to reach the most affluent and influential customers, you had no choice. You had to advertise in the Post. There was no viable second option. This gave the newspaper a virtual stranglehold on local advertising revenue. This is the key. During the high inflation years of the mid to late 1970s, this structure became a gold mine. The Post's own costs were going up, the price of newsprint, the salaries of its journalists. A lesser paper in a competitive city like New York would have had its margins crushed, but under the brilliant leadership of its publisher, Katharine Graham, the Washington Post could simply call up its advertisers and raise its ad rates. The department stores, facing their own inflationary cost pressures, had to pay up. They had nowhere else to go. The Post was able to pass on all of its cost increases plus a little extra directly to its customers. Its nominal profits soared right along with inflation, meaning its real, inflation-adjusted profitability remained robust. Buffett called businesses like this economic royalty. They could effectively levy their own private tax on the commerce of their territory. He famously noted that a great business is one that can increase its prices and have the customer say thank you for not raising them more. While inflation was ravaging the balance sheets of capital-intensive, commodity-type businesses, it was barely touching the real earning power of a franchise like the Washington Post. This experience solidified a key pillar of his strategy. In an inflationary world, the single best investment is not gold, not real estate, but a wonderful business with the durable power to raise its prices. The extraordinary ability of a business with pricing power to thrive during inflation is once again rooted in human psychology. The key principle at play is one of the most powerful motivators of human behavior: loss aversion. First identified by psychologists Daniel Kahneman and Amos Tversky, loss aversion is the finding that for most people, the pain of losing something is psychologically about twice as powerful as the pleasure of gaining something of equal value. Losing $100 feels much worse than finding $100 feels good. How does this apply to pricing power and inflation? During an inflationary period, businesses with a strong moat can frame their price increases in a way that leverages the customer's loss aversion. Let's consider a piece of essential business software, like Adobe Photoshop. A graphic designer has built their entire workflow, their skills, and their career around this one tool. It is deeply integrated into their professional life. Now, inflation hits, and Adobe's costs for talented engineers go up. Adobe announces a 10% increase in its monthly subscription fee. The customer's first reaction is annoyance. But then, their brain performs a loss aversion calculation. On one hand, there is the certain, but relatively small, loss of paying a few extra dollars a month. On the other hand, there is the potential for a much larger, more catastrophic loss: the loss of the tool itself. To avoid the price increase, the designer would have to switch to a new, unfamiliar software. This would involve the loss of their productivity, the loss of their established workflow, the loss of years of accumulated skill, and the risk that the new software might not be as good, potentially leading to the loss of clients or income. Faced with this choice, the pain of the potential losses associated with switching is vastly greater than the pain of the small certain loss from the price increase. The customer, powerfully motivated to avoid the larger loss, reluctantly accepts the price hike. Adobe has successfully used the customer's own loss aversion as a pillar of its economic moat. This stands in stark contrast to a business with no moat, like a restaurant in a crowded neighborhood. If that restaurant raises its prices by 10%, the customer feels no loss aversion about switching. In fact, they feel a sense of gain. They can go to the restaurant next door, get a similar meal, and gain the 10% they saved. The psychological forces are working against the commodity business, but they are working in favor of the business with high switching costs and a loyal customer base. Recognizing where the force of loss aversion lies, with the company or with the customer, is a crucial element of determining which businesses will be the winners and which will be the losers in an inflationary environment. This is a level of stock analysis that goes beyond the spreadsheet and into the realm of behavioral finance. How can we as investors systematically apply this insight? We need a mental model to evaluate a company's resilience in the face of rising prices. Let's call it the inflation stress test. It's a thought experiment to run on any potential investment to gauge its true pricing power. Step 1. Identify the cost structure. First, analyze the business's major costs. Is it heavily dependent on a specific raw material, like oil for an airline or cotton for a t-shirt maker? Is its biggest expense labor, like a consulting firm? Or is its cost base relatively fixed, like a software company that has already built its product? Understanding what drives the company's expenses is the first step to understanding its vulnerability to inflation. Step 2. The input cost shock. Imagine a scenario where the company's primary costs jump by 10% across the board. The price of jet fuel soars. The wages for software engineers rise sharply. The cost of coffee beans for a cafe chain increases. This is the stress part of the test. How does this shock impact the company's income statement? Initially, for every company, it crushes their gross margins. Step 3. The pricing power response. This is the crucial step. Now, assess the company's ability to respond. Can it confidently pass that entire 10% cost increase, and perhaps a little more, onto its customers in the form of higher prices? To answer this, you must analyze the company's competitive position. Does it have a strong brand? Are there high switching costs for its customers? Is it the dominant player in its market? Let's run this test on two companies, a luxury watchmaker like Rolex and a budget airline. For Rolex, the cost of steel and skilled labor goes up by 10%. Can they raise the price of a watch by 10 or even 12%? Absolutely. Their customers are buying the brand, the status, and the history. The price is a feature, not a bug. Demand might even increase. Rolex passes the stress test with flying colors. It is an inflation-proof fortress. Now, the budget airline. The cost of jet fuel and labor goes up by 10%. Can they raise all their ticket prices by 10%? Not a chance. They are in a brutal commodity business. If they raise their fares, their price-sensitive customers will instantly flock to a competitor who hasn't raised prices as much. The airline is forced to absorb the vast majority of the cost increase. Its already thin profit margins are wiped out, and it plunges into losses. The airline fails the stress test catastrophically. Step 4. The capital expenditure test. Finally, consider the impact of inflation on the company's need for new investment. A manufacturing company will find that the cost of building a new factory has soared. It needs to retain more of its already dwindling earnings just to stand still. A software company, by contrast, has far lower capital needs. Its primary asset, the code, does not need to be replaced at an inflation-adjusted price. This is why Buffett loves businesses that require little incremental capital. They are far more resilient in an inflationary world. By applying this 4-step inflation stress test, you can develop a much clearer picture of a company's true economic durability. It forces you to think like a business owner, not a stock market speculator, and helps you identify the high-quality stocks that can protect and grow your wealth through any economic climate. The antithesis of the inflation-proof fortress is the path of the 99%, the business that is perpetually squeezed by rising costs and intense competition. This is the tragic story of the average grocery store chain. It is a business model that appears stable and essential, but from a financial perspective, it is one of a company caught in an economic vice. Imagine a typical grocery chain, ShopMart. It operates on famously thin net profit margins, often just 1 or 2%. A 1 or 2 cent profit on every dollar of sales. Now, an inflationary wave hits the economy. The price of produce from farmers goes up. The wholesale cost of packaged goods from companies like Kraft and Procter & Gamble goes up. The wages for its cashiers and stockers go up. The cost of electricity to run its refrigerators goes up. Every single line item on its expense ledger is rising. ShopMart's management is in a terrible bind. They are facing, let's say, a 5% increase in their overall cost of doing business. To maintain their tiny profit margin, they need to raise the prices on the shelves by 5%. But they operate in a brutally competitive environment. Across the street is a Kroger. Down the road is an Aldi, which competes aggressively on price. And looming over all of them is the behemoth, Walmart, with its immense buying power and scale. If ShopMart raises its price for a gallon of milk by 5%, but Aldi only raises it by 2%, price-sensitive customers will switch. There is very little brand loyalty to a grocery store. People will drive an extra 5 minutes to save $20 on their weekly grocery bill. The pain of switching is virtually zero. ShopMart has no moat. It cannot exercise pricing power. The result is a catastrophic margin squeeze. The grocery chain is forced to absorb most of the cost increases. Its net profit margin, which was a skinny 2% to begin with, might shrink to 1% or even turn negative. The company is now working harder than ever with higher revenues due to inflation, but is making less money or even losing it. Its stock price will be punished as investors realize its business model is fundamentally broken in an inflationary environment. This is the plight of the 99% of businesses that lack a durable competitive advantage. They are price takers, not price makers. They are at the mercy of their suppliers on one side and their customers on the other. With powerful competitors boxing them in, they are caught in the middle, and their profits are the first casualty of any economic turbulence. An investor who understands this dynamic will know to avoid these margin-squeezed industries and seek out the rare businesses that own their own toll bridge, the ones that can pass rising costs through to their customers with ease. This distinction is a critical component of a successful long-term investing philosophy aimed at beating the market. The direct financial connection between pricing power and inflation resilience is most powerfully demonstrated in a company's ability to generate growing free cash flow in real inflation-adjusted terms. Free cash flow is the lifeblood of a business. It's the cash that is left over for the owners after all operating expenses have been paid and all necessary capital expenditures have been made. It is the cash that can be used to pay dividends, buy back shares, or make acquisitions. For an investor, a company's ability to generate and grow free cash flow is the ultimate measure of its value. Let's see how this plays out for two companies during a period of 5% inflation. First, our squeezed grocery store, ShopMart. In year one, with no inflation, let's say it generates $1 billion in revenue and produces $20 million in free cash flow, a 2% free cash flow margin. In year two, with 5% inflation, its revenues rise to $1.05 billion. But because its margins are squeezed, its operating profits might stay flat or even fall. Worse, the cost of maintaining its stores and replacing its equipment also goes up by 5%. It has to spend more on capital expenditures just to stay in the same place. The result? Its free cash flow might fall to $15 million. In nominal terms, it has shrunk. In real, inflation-adjusted terms, it has collapsed. The business is going backward. Now consider our economic royalty, a dominant brand like See's Candies. In year one, it generates $200 million in revenue, and because it's a high-margin, low-capital intensity business, it produces $60 million in free cash flow, a 30% margin. In year two, with 5% inflation, it raises its prices by 8%. Its revenue grows to $216 million. Because it raised prices by more than inflation, its operating profit margin expands. Its capital expenditure needs are minimal and might only rise with inflation to, say, $5.25 million. The result? Its free cash flow might grow to $70 million. In nominal terms, it has grown by over 16%. In real inflation-adjusted terms, it has grown by a very healthy 11%. This is the profound difference. One business sees its real earning power wither away in the face of inflation, while the other sees it accelerate. The company with pricing power is a machine that converts the tax of inflation into higher real returns for its owners. Its free cash flow stream, which is what an investor is ultimately buying, becomes more valuable, not less. This is why Buffett's wealth management strategy is so heavily focused on these types of businesses. He is not just looking for earnings, he is looking for high-quality, inflation-protected earnings that translate into a growing river of cash. When you conduct your stock analysis, don't stop at the earnings per share number. Dig deeper into the cash flow statement. A history of consistently growing free cash flow, especially during inflationary periods, is the clearest and most direct financial evidence that you have found one of the rare, high-quality stocks with an unbreachable economic moat. We have now deconstructed the definition, the source, the opposite, and the benefits of pricing power. The final and most critical pillar of our journey is the practical application. How do we, as diligent investors, actively hunt for these companies? How do we find this economic royalty in the vast, confusing jungle of the stock market? To find our answer, we must turn to one of Buffett's most brilliant and daring investments, a story that demonstrates how to find supreme pricing power when it is hidden by fear and uncertainty. This is the story of the American Express salad oil scandal. In 1963, American Express was not primarily the credit card giant we know today. A huge part of its business was in warehousing and field warehousing, where it would certify and hold inventory that companies used as collateral for loans. One of its clients was the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino de Angelis. Allied borrowed massive sums of money from Wall Street banks, secured by its supposed inventory of salad oil, which was certified by American Express. The problem was, the inventory was a fraud. The giant tanks were mostly filled with water, with only a thin layer of oil floating on top. When the fraud was discovered, Allied collapsed, defaulting on loans worth what would be over $1.5 billion in today's money. Wall Street panicked. American Express was on the hook for the fraudulent warehouse receipts. The market feared that the losses would be so immense that they would bankrupt the company. Its stock price was cut in half in a matter of weeks. The consensus view was that American Express was finished. This is where Buffett's independent thinking and investigative process set him apart. He ignored the screaming headlines and the panic. He thought, the market is terrified of the warehouse division. But what about the real business? What about the credit cards and the traveler's checks? He decided to do his own primary on-the-ground research, what is now famously called scuttlebutt. He went to restaurants and hotels in his hometown of Omaha. He talked to the cashiers and managers. He asked them, "Are you still seeing people use American Express cards?" He went to local banks and talked to the tellers. He asked, "Are people still buying American Express travelers' checks?" He even talked to his competitors in the travel check business. The answer he got back was a resounding, universal yes. He discovered that the scandal in the warehouse division, while a huge financial problem, had not dented the trust that the average consumer and merchant had in the core American Express brand. People weren't throwing away their Amex cards. Travelers weren't afraid the company's checks would bounce. The brand's power, its economic moat in the payments and travel space, was completely intact. The business possessed immense pricing power with its cardholders, who paid an annual fee, a rarity at the time, and with merchants, who paid a percentage of each transaction. This moat was completely separate from the salad oil mess. Buffett realized the market was making a classic mistake. It was confusing a temporary, solvable balance sheet problem with a permanent impairment of the core business franchise. He concluded that the value of the traveler's check and credit card businesses alone was worth far more than the company's devastated stock price. With immense conviction, he invested 40% of his partnership's capital into American Express stock. It was the single largest investment he had ever made. Over the next few years, the company sorted out its legal issues, the scandal faded, and the market recognized the enduring power of its core franchise. The stock soared, and Buffett made a fortune. The lesson was clear. The best time to hunt for economic royalty is often when it is disguised by a cloud of bad news. The market's short-term fear can provide the long-term investor with the opportunity to buy a fortress at the price of a ruin. The salad oil scandal is a masterclass in overcoming the cognitive biases that plague the average investor. The two most prominent psychological errors that Buffett avoided were the availability heuristic and confirmation bias. The availability heuristic is our mental shortcut of judging the likelihood of an event by how easily an example comes to mind. In 1963, the story of the salad oil fraud was everywhere. It was dramatic, shocking, and easy to recall. For most investors, the availability of this terrifying headline dominated their entire perception of American Express. The mental image of bankrupting losses was so vivid that it crowded out any rational analysis of the company's other, healthy businesses. They overweighted the dramatic, recent news and ignored the long-term, stable reality of the brand's strength. Buffett, by contrast, deliberately ignored the easily available headline and went in search of less available, but more important, data from primary sources. This is where he overcame the second bias, confirmation bias. This is our natural tendency to search for, interpret, and recall information in a way that confirms our pre-existing beliefs. An investor who was scared by the headline would actively look for news that confirmed their fear, articles about the potential size of the lawsuits, rumors of other problems at the company. Their mind would be closed to any contradictory evidence. Buffett did the opposite. His pre-existing belief was that a great brand is a powerful asset. His hypothesis was that the Amex brand was still great, so he went out and actively sought to test and potentially disprove his own hypothesis. He wasn't asking leading questions, he was asking neutral questions. What are you seeing with your own eyes? If the bankers and merchants had told him that people were cutting up their Amex cards, he would have abandoned the investment. His process was scientific. He formulated a hypothesis and then gathered real-world evidence, whether it confirmed his view or not. This intellectual honesty is exceptionally rare. Most people use research as a tool to make themselves feel better about a decision they have already emotionally made. Buffett uses research as a tool to discover the truth, even if that truth is uncomfortable or contradicts his initial hunch. Mastering this ability to think independently and to actively seek out disconfirming evidence is the final, and perhaps most difficult, step in transforming from an amateur speculator into a professional practitioner of value investing. So how do we operationalize this mindset? How do we create a systematic process for hunting economic royalty? We need a final, applied mental model, the pricing power due diligence checklist. This is a practical, multi-step guide to use when analyzing any potential long-term investment. Step 1. Historical margin and return analysis. This is your quantitative foundation. Go to the company's financial reports and look at the last 10 years of data. Specifically, you are looking for three things: a high and stable or rising gross profit margin, a high and stable or rising net profit margin, and a consistent history of high return on invested capital, ROIC, preferably above 15%. This decade-long view smooths out the noise of single good or bad years and reveals the underlying economic character of the business. A company that has maintained high margins and returns for a decade clearly has some kind of durable competitive advantage. Step 2. The brand and switching cost audit. This is your qualitative check. Apply the mental models we've already discussed. Does the brand pass the verb test or the no-logo test? Does it evoke a powerful emotion? More importantly, analyze the pain of switching for the customer. How difficult, expensive, or annoying would it be for them to move to a competitor? For a company like Microsoft with its Office suite, the switching costs for a large enterprise are immense. For your local pizza place, they are zero. The higher the pain of switching, the deeper the moat. Step 3. The price history investigation. This is your scuttlebutt research phase, inspired by Buffett's Amex investigation. Look for evidence of the company's ability to raise prices. Read through their annual reports. CEOs will often boast about strong pricing or realizations. Look for news articles or analyst reports that discuss the company's pricing strategy. You can even do your own primary research. Call the company's sales department and ask about past price increases. Look at historical catalogs or web archives. You are looking for a documented track record of successfully passing on price increases to the customer base. Step 4. The what-if scenario test. Apply the inflation stress test we developed earlier. Imagine a future with high inflation. How would this business perform? Now, imagine a different scenario. A deep recession. Would the company's product be one of the first things consumers cut from their budget, or is it an essential, non-discretionary purchase? A company that can thrive during inflation and remain resilient during a recession is a true all-weather fortress. By rigorously applying this 4-step due diligence checklist, you combine quantitative financial analysis with qualitative business judgment. It provides a comprehensive framework for stock picking that is built on the core principles of Warren Buffett's strategy. It trains you to ignore the short-term noise of the market and focus on the one thing that truly matters for long-term portfolio growth: the durable, unbreachable competitive advantage that allows a business to be the master of its own destiny. The ultimate and most common failure in the hunt for economic royalty is to mistake a flash in the pan for an enduring flame. The antithesis of this entire philosophy, the path of the 99%, is to chase the illusion of growth without ever questioning its quality or durability. This is the seductive trap of the hot growth stock with no pricing power. Imagine a hypothetical tech company, Cloudburst. It offers a new cloud storage solution for businesses. It enters the market with a great product and, crucially, a very low introductory price. The market is huge, and businesses are eager for cheaper storage. Cloudburst's revenue growth is spectacular. It goes from $1 million in sales to $10 million to $100 million in just a few years. Its stock price goes parabolic. It becomes a darling of the financial media. Analysts praise its visionary CEO and its massive total addressable market. The average investor, drawn in by the exciting story and the rocketing stock price, buys in. They see the 1,000% revenue growth and assume they've found the next Amazon. But they have failed to apply our checklist. They have failed to ask the single most important question: does this business have pricing power? Let's put Cloudburst to the test. Its margins are thin, or even negative, because it is spending heavily on marketing and subsidizing its prices to acquire customers, so it fails step 1. It has no brand recognition and zero switching costs. A customer can move their data to a competitor like Amazon Web Services or Google Cloud overnight with minimal disruption. So it fails step 2. Its price history is one of discounting, not raising prices. It fails step 3. And in an inflationary environment where its costs for engineers and servers are rising, it has absolutely no ability to pass those costs on. Its only weapon is being the cheapest, a losing strategy. It fails step 4. Cloudburst is not an economic fortress, it is a house of cards. The moment its venture capital funding runs dry, it will be forced to raise prices to survive. But because it has no moat, no loyal customer base, and no brand power, its customers will flee the moment a cheaper alternative appears. The spectacular revenue growth will reverse, the exciting story will fall apart, and the stock price will collapse back to earth. The investor who bought at the top is left holding a bag of worthless shares, wondering what went wrong. What went wrong is that they confused growth with value creation. They bought a business that was a price taker, not a price maker. They invested in a company that was renting customers with cheap prices, not earning their long-term loyalty. This is the most common path to ruin in modern markets. It is the antithesis of the value investing discipline that demands a deep and durable competitive advantage as the non-negotiable price of admission for any long-term investment. The final, tangible result of successfully identifying and investing in companies with durable pricing power can be seen in the compounding growth of shareholder equity on the balance sheet. This is the direct financial connection that ties all these concepts together and serves as the ultimate engine for long-term wealth creation. Shareholder equity, also known as book value, is the net worth of a company, its assets minus its liabilities. For a truly great business, this number should grow at a high and consistent rate over time. Let's see why a business with pricing power is uniquely equipped to achieve this. Our company, Fortress Inc., has a strong moat and high returns on capital. In year one, it earns $100 million in profit. It only needs to reinvest $20 million of that back into the business to maintain its operations and fund its growth. The remaining $80 million is free cash flow. This $80 million belongs to the owners. The company can use it to pay a dividend, or it can use it to buy back its own stock. But let's say it retains the cash. That $80 million is added directly to the shareholder equity on its balance sheet. The book value of the company grows substantially. Now consider a commodity business, Hamster Wheel Company. It also earns $100 million in profit. But because it's in a capital-intensive industry, it has to reinvest $90 million back into the business just to replace its old equipment and stay competitive. It is left with only $10 million in free cash flow. Its book value only grows by this small amount. Over a decade, the difference is staggering. Fortress Inc. will have added hundreds of millions of dollars of retained earnings to its shareholder equity. Hamster Wheel Company will have added very little. The intrinsic value of Fortress Inc. is compounding at a high rate, while the value of Hamster Wheel Company is stagnating. Over the long run, the stock prices of these two companies will inevitably follow the trajectory of their underlying book value per share. This is the financial endgame of the Warren Buffett strategy. It is not about timing the market or finding quirky statistical bargains. It is about identifying businesses with such powerful competitive advantages, chief among them, pricing power, that they can produce high returns on capital, generate floods of free cash, and compound their intrinsic value year after year. This methodical growth in the underlying worth of the business is what drives spectacular long-term portfolio growth. It is the foundation upon which true, lasting financial freedom is built. The hunt for pricing power is the hunt for these compounding machines. It is the most reliable path to beating the market ever devised. You have just spent this time not merely watching but actively rewiring the way your mind analyzes the world of business. You have acquired a new lens, a powerful filter that cuts through the noise and reveals the true source of durable corporate value. You no longer see just a company. You see an economic fortress or a price taker's prison. You no longer hear about revenue growth and ask, how much? You ask, how profitable and how durable? You have acquired the lens of pricing power, the mental model that Warren Buffett has used to turn a small textile mill into a $500 billion empire. This is a profound and permanent upgrade to your investment toolkit. But identifying the fortress is only the first half of the equation. The greatest business in the world can be a terrible investment if you pay too high a price for it. This introduces a second, equally critical variable into the value investing philosophy, a principle that acts as the essential partner to the concept of the economic moat. It is the principle of margin of safety. Knowing what a business is worth is one thing. Having the discipline to buy it for far less than it is worth is another. This is the crucial bridge between identifying a high-quality stock and executing a highly profitable investment. How do you connect the qualitative strength of a business's pricing power to a cold, hard, quantitative number for its intrinsic value? How do you determine the price at which a great company becomes a great investment? That is the next piece of the map. It is the link that connects business analysis to portfolio management. The video that is now appearing on your screen is that missing link. It is the second pillar of the intellectual temple. Most people will stop here, content with this one powerful idea, and that is a significant step. But you are not most people. You have demonstrated a commitment to go deeper. You are on a path to assemble a complete mental arsenal. To connect the quality of the business with the price you pay. The choice to continue, to complete the model that turns great insights into great returns, is yours. Click and continue your ascent.